Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, Financial Enhancement Group. Thank you for giving us a few minutes of your time. I also have Andrew Thrasher, Portfolio Manager and our Chartered Market Technician. So thank you again for joining along. We're going to talk about a few topics this week. Before we get into that, there certainly is a lot of negativity around us and things around the world we probably could devote more time to, and it's tough to get wrapped up in those, or tough to not get wrapped up in those, but there's some good things going around it. Andrew, both of us like basketball, so it's still okay to take a look around, and we film this on Tuesday, so tonight starts sectional play, and we love high school basketball, and we've of course got round 2 of Indiana Purdue Saturdays, or I think it's Saturday, so should be some fun times around here in Indiana.
Yeah, boiler up.
I wouldn't have passed you the ball, so to speak, pun intended, if I knew you were going to say that, but I should have known. But let's go back into finance. Well, we're going to talk about international versus domestic. Earlier in the year, we gave a brief update on that, and so it's important, especially as we have activity around the world. Where do we want our assets positioned? We'll look at preferred stock, a pretty boring topic, but made some portfolio changes. Thought we'd just take a second and discuss the positioning for there and why it makes some sense to increase there. And then lastly, commodities. And just as a note, so much of our thought process when we think about how are we invested, what are we buying, what are we selling, is focused in on this stock versus cash. And often our attention is not necessarily whether we're all in or all out or right position in the right asset classes, but looking for the thing that's doing well. Even in bad stock market environments or bad bond environments, we could find areas that are doing well. And right now that seems to be commodity. So we'll dive deeper into that one. But let's start off with international versus domestic stocks. So I've seen this relationship transition a few times. Got back into the business in the year 2000, 2001. In that era, and that began a positioning to a long stretch of solid success for international stocks that went on through 2008. From that point in time, it's been much better to be in the United States. We wanted to be domestic, and that has held true for a remarkably long period of time. So this is just a brief update. That's one of the most important questions we have, whether to have the assets positioned abroad or positioned domestically, and especially as we have global turmoil. Where are things positioned now? So just kind of walk you through this chart. The orange is the S&P 500. The purple is EFA, which is really the developed world. EFA is Europe, Australia, and the Far East. So Japan and Germany, France, that's going to be the lion's share of that index, but essentially as a proxy for other developed countries that aren't the United States. And then the blue are emerging markets. And so emerging markets really held on for a long period this time of staying positive. If you just look at the year 2022, but have turned negative and accelerating down to the downside. So the update here is actually that we're still in a domestic-led stock environment. There was a nice long run for internationals, but it wasn't enough to take the allocation. And the way we look at our portfolios, we run a set of rules, just like think of it like the risk barometer, but for whether we want to be domestic or international. And we follow those rules for how we want to be positioned. And that has kept us into international stocks. Now, Andrew, you designed this and were instrumental in helping orchestrate how we position this. So I'll kind of let you add a couple cents on what you've seen in this area and why we have assets where we do.
Yeah, so one of the ways that we often will look at, do we want to have international exposure? That's kind of the first question before we can even get to what kind of international exposure we want to have. Is anytime we want to take our foot and step outside of domestic markets, go anywhere, whether it's emerging markets or developed markets or anywhere else in the globe, we need to be, most likely those are going to be a bit higher risk investments. You're not only taking on exposure to other companies that are outside our economy, but it's also you have some currency issues if it's not currency hedged. So you're taking a bet on other currencies as well. So taking on that other risk, we need to be compensated for that risk. So something that we often will look at is our international markets, how are they performing relative to domestic markets? It's one thing if we have foreign markets that are on an absolute basis going higher, but if they're also going higher, but they're not outperforming our markets, then again, we're not being compensated to take on that international risk. So we often will look at it from a two different lenses. How are they performing on an absolute basis? Are their trends going higher? And how are they performing on a relative basis? Are they outperforming the S&P 500 or the Dow or any of our major markets here? If both those questions are yes, then okay, then we start to kind of dig a little deeper and try to uncover maybe where we want to have some specific exposure to certain countries or certain markets or sectors that are heavily influenced internationally. But if they're not, if their trends are going negative, if their relative and absolute trends are both trending lower, then we're not really overly interested. We may keep a small base allocation there just for diversification's sake, but we don't want to get too much exposure unless we're going to get rewarded for it.
Eloquently said. And yeah, so our recent activity has been, especially as we're in a defensive risk barometer environment, to pare back some of those riskier holdings, including emerging markets. Take a look now at preferred stock. So preferred stock, if you're unfamiliar with the asset class, is a unique corner of the investment world. It is best thought of as a hybrid. It's partly stock, and it's like the name indicates, but oftentimes it behaves a little bit more like bonds. It has a fixed payment. You're not going to earn an appreciation based on the performance of the company. You're going to be paid a fixed return at best. And the way it works to find itself as a hybrid, they are in the middle of the capital structure, meaning that if there is a company that goes under, the bond investors will be paid before the preferred stock investors, which will be paid before the actual common stockholders. So they're somewhere in the middle there from a risk perspective. But keep in mind they're ahead of the common stock investors. So they're a little bit less risky. So as we go from offense to defense, we find a sweet spot here to add to preferred stocks, not only for that reason, but they've actually gained in attractiveness. So as we've seen one of the most horrendous starts to a bond market, at least through, say, the first 6 or 7 weeks of this year, preferred stock really sold off hard. And so what we're looking at here is a variety of preferred stocks. A couple of the main ways in which these are issued. They're issued in $1,000 per share variety. And those are often referred to as institutional. So being $1,000 per share, it's more commonly the institution which buys those up. And then you have retail investors, which will buy the $25 issue. And we see a disparity now. That green line is the yield to call. So what is the yield on the fixed income or preferred stock? As it's moving higher, that means investors are selling off. You can see that green line really begin to accelerate and go up near 7%. Here. That indicates that it's the retail investors who have been selling here. So oftentimes we're offered an opportunity to run counter to what the smaller retail investors are doing. And I think this is one of those examples, at least is appealing, where they've behaved a little bit more aggressively than the institution. A lot of that can be stemmed because there were some losses in the earlier part of the year, and that caused them to flee that. So we see an opportunity to at least begin to add to preferred stocks when you see that symbol. That's some of the thinking. Of course, there's a little more to it than that. But for today's purposes, we'll leave it at that. And we'll transition into commodities, a little bit more exciting in today's unique environment. Andrew's really been out in the forefront in laying the case for commodities for quite some time now. And most of our portfolios, depending on the constraints and the legal framework that we have for them, you will typically find some commodity exposure one way or the other. And we've really seen a unique environment here, haven't we, Andrew?
We have. I feel like I have to talk about commodities every week in our allocation meeting. I think the advisors are probably starting to groan when I get to my section on we're going to talk about commodities again. But it continues to be a very important topic. Before we even had the issues going on with Russia and Ukraine, we were talking about the rising costs of fertilizer and the impact that was having on crops. We were talking about the energy crisis in Europe and the price of Brent crude there and also of natural gas were hitting huge high levels, making it extremely expensive for heating homes and just in general production. But energy markets and agricultural markets continue to be even now more getting in the spotlight. When we look and discuss kind of the impacts of Russia, Ukraine, we talked last week that we don't need to be war generals to invest during this time and try to gameplay what's going to happen there. But one thing we do have to recognize is some of the rippling effects of when there is a crisis, when there's something going on internationally, and what that will flow over to the financial markets. And commodities are a perfect example of that. Just Ukraine and Russia alone provide for about a fifth of the global supply of corn, and I believe about a third of the wheat. Ukraine actually provided a third of the supplies for corn to China, which they use to feed their world's largest pig herd. I know we're getting really, really kind of detailed with this, but it shows the huge impact these two countries by themselves have had on commodity prices. Corn is up about 6%, wheat's up about almost 17%, soybeans about 3%, just since February 22nd. We're seeing some big moves, and these are already on top of some very large price increases that the commodities have already experienced. So these are going to, we believe, continue to have an impact on not just what's going on in Russia, Ukraine, but there's other inputs that we could, if we had more time, we could dive into that I think are going to be impacting the commodity market, both on the energy side and the agricultural side. If these prices stay elevated, they'll continue to, again, have those rippling effects across our economy. Food's a big part of the inflation basket. It makes up about 14%. And so not just on the rise in food costs, then the inputs for everything else that use natural gas and fertilizer and just the energy market as a whole. So we're very, very keyed into what's going on in the energy and the commodity space. You can see the chart here that commodities have actually had one of the largest year-over-year increases. To 2022, it's up 105%, the CRB commodity index. This chart goes back to 1915. This is a long-term chart. You can see some of the other notable dates there where we've seen major increases. They've all almost kind of been dwarfed by what's going on in this year. Does this mean this will persist for the rest of the year? We don't know. What we can only know is as the data comes out. But commodities are definitely on the forefront of the financial market's mind, and they're definitely have our attention.
Yeah. Thank you, sir, for that. And thank you all for giving us a few minutes of your time. This is your weekly reminder to give us a call to come in and see us if you haven't yet. You can give us a call, 800-928-4001, or scan the QR code. And also, don't forget you have our weekly radio show that you can catch over the airwaves or through podcast form. So thank you again, everybody. Have a great weekend. Enjoy the basketball if you're so inclined as a fan, whether that be high school or college. Just enjoy the weather and the ball, and we'll look forward to seeing you next week.